I got this over to Josh. Okay, great. Well, thanks again for your patience, and we will have the economic calendar issued and published on the website. Actually, Josh, do we have that out? We don't have that out there yet, right? We usually do it post the first recording of the day.
I'm sorry, repeat it again? The economic
calendar that we're going to go over. It'll be here on the webinar, not on the website yet.
Yeah, we'll launch that live as soon as we get the recording up. That's right.
Okay. Well, that'll be out there for the rest of the week, as typical. And as you know, we already had some information this morning that showed retail sales were relatively strong, but ex-autos a little weaker. So it was mixed, and bonds have actually reacted favorably. The stock market's still rallying, and bonds are still rallying with it. And so we've actually nothing that would further improve rates yet today, but it looks like we're still getting plenty of strength in both treasuries and mortgage backs still this morning. A brief overview, as we like to do on this too. Last week, mortgage pricing did improve. Again, that was the third week in a row, and you can really thank the Fed for that, as they kept the mortgage-backed security purchase program is obviously, as you know, still intact through March, and that's still robust. And they really were the big purchaser of mortgage backs last week and kept mortgage pricing favorable. And as you know as well, the economic calendar was light last week. We did have the Treasury auctions. I just wanted to cover that again if you didn't see it in our emails, but those went pretty well. As we got further out the curve, once we got to the 30, it was a little light, but still plenty strong. Lots of demand still from foreigners and banks on all the bonds. So good news for mortgage pricing still. And as you noted in the email we sent last night, credit spreads are almost back to normal. And so still positive for mortgage pricing as the 10-year moved some. Spreads continue to improve, and that would likely keep mortgage rates in the range that we've been in here for a while. Consumer sentiment was a little weaker. Still shows a consumer that is challenged with credit and access to credit and, of course, employment. And then in other news last week, and we published, I tried to recap some of the stuff we published that maybe didn't capture here on this week ahead. You would have also seen the Senior Loan Officer Survey showed that credit is still tightening. And as you all know, DU 8.0 will come out, and that will be contributing to that tightening as well. So access to credit, while credit is cheap, relatively speaking here for mortgages, it is still tough for a lot of consumers to qualify. We did get 2010 loan limits have been announced, and high cost, as you saw, loan amounts were extended. And then also last week, refi apps up as rates are down, and purchase apps are still challenged here at 9-year lows, frankly. But we'll get more information on that this week, too, as we see some housing start demand. Okay, so let's take a look at the, okay, good, we got the calendar up here. So tomorrow morning, we start off with some pretty impactful data, and so you'll want to stay close. This is PPI, and this will measure inflation at the wholesale level. It is high impact in that that does give us an indication of what could bleed through to the consumer. It also would start to, as you would see that coming up in a significant way, of course, that would signal Fed and get their attention. And so everybody be watching that. If we get numbers that are outside expectations, let's say higher than expectations, so meaning that we're getting some inflation in the process or in the system, that would be negative for bonds, and we certainly see a knee-jerk reaction from that as we usually notify you, and we'd watch how that would trade through. But again, the expectations are that it's fairly benign at the wholesale level, and so we'll keep you posted first thing tomorrow morning, and that's prior to markets opening. And then at 9:15, we'll get both industrial production and capacity utilization. We've got a high impact here. I mean, frankly, it should be of medium impact to mild impact. It's really just a view of how factories, their production levels and utilization for their capacity. And so it is a view of the strength of the economy, obviously, but and can impact the employment picture. But that should really be probably moderate to medium impact. I don't see much challenging, and that's at 9:15 tomorrow. Again, these are, as we always say, these are Eastern time. And then on Wednesday, we'll get some housing information. So we'll get housing starts and building permits. That, again, 8:30 Eastern, right before the market, an hour before the market opens. And those are typically of medium impact. I mean, we'll see, housing starts and permits. I mean, really, most influential data on housing would look more at sales, but certainly starts and permits will be something that'll be looked at as whether the housing market is continuing to stabilize and heal. Also, 8:30, we'll get the CPI, and that will be a number that'll be more widely watched for impact here. And that's a measure of inflation, unlike PPI. This is a measure of inflation at the consumer level. And so that can have even bigger impact than Tuesday's morning's data. So you'll want to definitely be posted, and that's an hour before markets open, an hour before rate sheets are set by most lenders. We'll keep you posted bright and early tomorrow morning. Wednesday morning as well. And then Thursday, we'll run into Thursday. Big data, we get this every week, but we'll get the weekly jobless claims. Again, just based on where that information comes in, if it's above expectations, worse or better, can certainly have an impact. So again, that's an hour before the market's open. We'll want to stay tuned for that. And then we'll get into Thursday, 10 o'clock, we get leading economic indicators, Philly Fed Business Index. Leading economic indicators is just a compilation of about 6 reports that try to predict economic activity 6 months out. And then, of course, the manufacturing, Philly, it's business activity in the Northeast. That actually was a market mover last time that was published because it did show significant more weakness than was expected, I think, in the business activity up in the Northeast. So you want to stay posted. Those shouldn't be big market movers, but they can be. And so you'll want to watch, you'll want to stay close to our emails and alerts that morning as well. And then we're off the hook on Friday. There's really nothing that we see moving the markets other than just the normal activity of money flows. So stay tuned. All right, and then we try to give you also on our weekly email, try to give you just our view of where rates are over the next, should be over the next 60 days. And again, that view has not changed. Economic activity still seems to be mixed. Certainly the consumer is not out of the woods yet, and we'll need to see that before the Fed or frankly others would start to consider monetary tightening. And so again, we don't see much of a change. There definitely will be volatility and choppiness along the way here, but we just can't see rates moving out of this 4 7/8 to 5 3/8 range on the 30-year fixed. And so that's good news is that rates are probably in a pretty tight range here in this, we've been describing this dynamic on the 10-year Treasury of the 3.3 to 3.50 yield range, and that still seems to be holding up as we're 3.38 here as we speak. And mortgage backs are still slightly improved too. So that is a view of the week ahead. It is. We do have some data. It could be a mover, and we have Bernanke speaking in. Gosh, I think he's speaking now at a luncheon, and so that can always, depending on what he says, can always move markets as well. But stay close. Even though last week was light on data, it was choppy, and we expect to see some volatility this week, and we would still bias towards just general bias towards locking just because of the attractive rates. We have mortgage-backed securities trading at near all-time highs. But again, you can cautiously float, as we say here as well. We don't see anything that's shocking the markets just yet. But at these prices, we are recommending to consumers and others that we bias towards a lock. Okay. Mr. Campbell, have we gathered any questions through the chat log here this morning?
I think we're all clear, my man.
Okay. Great. Thanks, everybody, for joining. If you aren't already a subscriber, which you likely would be, of the Mortgage Market, at least one version of our Mortgage Market and Rate Advisory service, Josh has the link right there. You can sign up, Rate Alert service. You also have options to sign up guests and referral partners. And don't forget to ask us about the group subscriptions as well. And if you're not yet accredited or don't know much about our accreditation program, please check it out. It does include the Rate Advisory and Alert service, and also many other bells and whistles that will help differentiate you from the others and ensure that consumers know that you've been endorsed by a third party. You're a fair consumer ethical lender. And with that, looks like no other questions are in the queue. We'll go ahead and wrap it up. Everybody have a great day, have a great week, and we'll keep you posted on how things trade out through the week. Have a great day.